If your trades keep failing, even when your market bias is correct, the issue is usually not direction. It is timing. Many traders can identify where price is likely to move, but they struggle to enter at the right moment. In trading, being early can be just as costly as being wrong. That is why having a clear entry model is essential for consistent execution. Welcome to the ComLucro channel. In this video, I will break down 5 powerful entry models used in smart money trading. These frameworks help align your entries with liquidity, market structure, and confirmation. Once you understand them, you will stop guessing your entries and start executing trades with much greater precision. By the end of this video, you will know when to enter, when to stay out, and how to approach the market with a structured plan. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. So, let us get started. Even if your market direction is correct, entering at the wrong moments will often still lead to losing trades. For this reason, entry models play a crucial role in building a profitable and reliable trading strategy. In reality, they represent one of the 3 core elements of a complete trading framework: identifying the optimal area of interest, waiting for confirmation, and executing through a well-defined entry model. In this video, I will break down my 5 personal entry models, the exact frameworks I use to execute and open positions in the market. Let's start with the first one, the breaker block entry model. Before we go deeper into the setup itself, let's briefly review what a breaker block is and why it matters in market structure. So, traders, what exactly is a breaker block? A breaker block is a trading concept built around a simple idea. It's a previously failed order block that transforms into a key supply or demand zone on the price chart. This happens when an order block is broken in the opposite direction, shifting its role from supply to demand or from demand to supply. In practice, a breaker block represents a structural role flip, where a former reaction zone becomes an area that price is likely to revisit, often serving as a mitigation point and a location where traders add to their positions. There is also an important principle to keep in mind. Whenever price breaks through a key demand or supply zone without showing respect, that zone automatically shifts its characteristic. A supply zone becomes demand, and a demand zone becomes supply. The same principle applies to order blocks. Now that we understand the core idea behind breaker blocks, let us return to the entry model itself. Among all my setups, this is one of my favorites, and I frequently use it for reversal entries. The reason is straightforward. This pattern forms in a way that suggests price is more likely to reverse. However, for this entry model to be considered valid, price must first originate from a higher time frame area of interest, such as a higher time frame fair value gap, a supply or demand zone, or after sweeping liquidity from a major swing high or swing low. You cannot take every breaker block that appears randomly in the middle of nowhere. In trading, context is everything. With that in mind, let us look at exactly how to execute an entry using this model. At this stage, we zoom into a lower time frame and closely monitor the market for signs of reversal. The first condition we need to see is a clear market structure shift or a strong change of character on the lower time frame. This becomes our first layer of confirmation. For a valid bullish breaker block, price should initially form a swing low, followed by a swing high, and then create a lower low. After this sequence, we need to see an immediate expansion move to the upside that breaks structure and confirms the shift. In this scenario, the up-close candle, or the series of up-close candles that form between the first swing low and the swing high, becomes your breaker block zone. That is the area you use to plan your long entry. To execute the trade, place a limit order at the highest point of that mitigation block and wait for price to retrace into it. For profit taking, you can target the nearest liquidity on the current time frame or aim for a higher time frame key level if you expect a larger move. The bearish breaker block follows the exact opposite logic. In this case, price should first form a swing high, then a swing low, followed by a higher high. After that, we need to see a strong bearish displacement move that breaks structure and closes below the swing low, confirming the market structure shift. Under these conditions, the bearish breaker block zone will be the down close candle or the series of down close candles formed between the first swing high and the swing low. To apply this entry model, place a limit order at the lowest point of the breaker block and wait for price to retrace into it. Your stop loss should be placed a few pips above the zone. For the take profit, you can target the nearest external liquidity on the same time frame, since we expect price to continue moving in that direction. Alternatively, you can aim for a higher time frame major liquidity level to achieve a better reward to risk ratio. Finally, if you prefer a more refined and slightly conservative entry, you can place your order at the midpoint of the point of interest. This approach often improves the risk to reward ratio by tightening your stop loss nearly in half, while also potentially doubling your R to R. Breaker blocks are often the main reason why price does not return to a fair value gap that forms immediately after a liquidity sweep or after tapping into a higher time frame area of interest. In many situations, breaker blocks are positioned slightly above or below the fair value gap. Because of this positioning, price is more likely to react from the breaker block first instead of fully filling the gap. That said, it is important to keep one thing in mind. When a breaker block overlaps with a fair value gap, that confluence significantly increases the probability of the setup. This overlap makes the breaker block zone much stronger and more reliable as an entry model. Now let us move on to the second entry model, the classic fair value gap model. Among entry techniques, this is the most common model, and it is considered a hybrid, meaning it can be applied to both reversal and continuation trades. To illustrate the reversal approach, let us consider a bullish scenario. The first condition is that price must originate from a higher time frame key area or sweep a major liquidity level. Once this occurs, we need to see a market structure shift on the lower time frame. This becomes our first layer of confirmation. After the structure shift is confirmed and we anticipate that price may continue higher, the next step is to look for a buying opportunity. At this stage, our focus shifts to identifying a bullish fair value gap that forms within the impulsive leg of the market structure shift. These zones often behave like magnets, drawing price back before the upward move continues. From there, we plan our buy entry by placing a limit order at the highest point of the fair value gap, while positioning the stop loss a few pips below the recent swing low. The bearish variation follows the same logic, simply mirrored in the opposite direction. From a personal perspective, I do not usually prefer using this model for the initial reversal entry. Instead, I primarily use it as a continuation setup, adding another position after price has already moved in my expected direction and my first trade is running in profit. Next, let us move to the third entry model, the mitigation block entry model. Among reversal setups, this entry model is considered one of the most powerful you can use. As with the previous models, for this entry to be valid, price must originate from a higher time frame key area, or form this pattern after sweeping a major liquidity level. Without that higher time frame context, the setup loses much of its strength. For a bullish mitigation block to develop, price must first create a swing low, then a swing high, followed by a higher low. After that, we need to see a strong bullish displacement move that breaks structure and closes above the previous swing high. In this scenario, the bullish mitigation block becomes the last up-close candle or series of up-close candles formed between the first swing low and the first swing high. To execute a long trade, place a limit order at the highest point of that mitigation block, with the stop loss set a few pips below the nearest swing low, and wait for price to retrace and activate the entry. It is important to note that this differs from a breaker block. With a breaker block, we look for a lower low to form rather than a higher low. The bearish mitigation block follows the exact opposite structure. Price must first form a swing high, then a swing low, followed by a lower high before a market structure shift occurs with a bearish displacement leg that closes below the first low. Under these conditions, the mitigation zone becomes the down close candle, or the series of down close candles formed between the first swing high and the swing low. Now let's move on to the fourth entry model, the IFVG entry. Among reversal setups, this is one of the strongest entry models, and it often produces very high-quality trading opportunities. Before we look at how to execute this setup on the chart, let us briefly review what an inversion fair value gap is and how it forms. Before we define what an inversion fair value gap is, we first need to review what a fair value gap is. Let us begin with the core idea. A bullish fair value gap is the price space formed between the high of the first candle and the low of the third candle within a 3-candle sequence. In the same way, a bearish fair value gap is the space between the low of the first candle and the high of the third candle. The color of the candles is irrelevant, and their shape or size does not change the concept. The psychology behind a bullish fair value gap reflects a buy-side imbalance, where buying pressure clearly dominates selling pressure and creates that inefficiency in price. When marking this manually on your chart, traders often highlight this area as a potential demand zone to look for long opportunities. The same logic applies in the bearish case. When price revisits a bearish fair value gap, traders anticipate a reaction and manually treat that area as a supply zone. So what exactly is an inversion fair value gap? An inversion, also called an inversed FVG, occurs when a previously identified fair value gap fails and price invalidates it. For instance, imagine a bullish imbalance that creates a clear gap on your chart. As price retraces back into that area, the expectation is a continuation to the upside. However, if the following candles close decisively below the gap, fully violating it, the market has disrespected that level, and this failure forms the inversion. Now, let us understand the psychology behind the inversion FVG. The appearance of an inversion fair value gap is often an early indication that momentum is shifting. It reveals that the side responsible for creating the original imbalance has lost control. This change in strength can signal a potential reversal in direction. From basic price action principles, we know that after a breakout, previous support can become resistance, and previous resistance can become support. The same principle applies to fair value gaps. When a bullish fair value gap that once acted as a demand area is broken to the downside, it transforms into a supply zone. As a result, we can anticipate a possible rejection from that inversion FVG toward the downside. Now that we have reviewed the concept, let us return to the entry model itself. In a bullish scenario, a valid IFVG entry requires price to first tap into or originate from a higher time frame area of interest or sweep a major liquidity level. From my personal experience, I prefer using this model after price sweeps a major swing high or swing low. Once the IFVG forms, it often holds as a new support zone, providing a solid area for a potential buy entry. When placing an entry using this model, you generally have two options. The first option is to enter immediately after the inversion fair value gap forms, placing your stop loss below the most recent swing low. The second option is to place a buy limit order at the highest point of the newly formed IFVG and wait for price to retrace into it. For the take profit, you can target the nearest buy-side liquidity on the current time frame, or aim for a key level on the higher time frame. The exact opposite logic applies in a bearish scenario. Now let us move to the fifth and final entry model that I use, the order block entry. This entry model is also a hybrid, meaning it can be applied to both reversal and continuation trades. Within smart money concepts, it is one of the most basic and widely used entry methods. Order blocks represent the footprints of smart money, areas where institutions initiate positions, typically at the origin of a strong move. These zones act as decisional areas where large volumes are placed before a major expansion, which is why price often reacts or reverses when it returns to them. In a bearish scenario, the bearish order block is the last up-close candle or the series of up-close candles formed right before a strong bearish move that causes a break of structure. On the other hand, a bullish order block is the last down-close candle or the series of down-close candles formed just before a strong bullish move that leads to a break of structure. From my experience, I mainly use order blocks on higher time frames, such as the 15-minute chart or higher. I generally avoid using them for entries on very low time frames, like the 5-minute or 1-minute chart. To execute an entry using this model, price must first tap into a key higher time frame area and begin showing signs of reversal. After that, we zoom in to a lower time frame and look for confirmation, such as a clear change of character. Once the change of character is confirmed, we identify the last up-close candle at the origin of the bearish impulsive leg that caused the market structure shift. That candle becomes our lower time frame bearish order block. This is the level where we place a sell limit order and wait for price to retrace and activate the entry. The bullish order block follows the same logic, simply mirrored in the opposite direction. However, it is important to remember that lower time frame order blocks are more likely to remain unfilled, so managing expectations and risk becomes essential. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include smart money concepts, technical analysis for day traders, trading psychology, and the Wyckoff method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.